Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Gita Gopinath has been Deputy Managing Director of the International Monetary Fund during one of the most transformative economic periods in modern history, including the pandemic, inflation shock and the push to deglobalize. After 7 years at the IMF, she's stepping down tomorrow and joins us now for a final conversation. Gita, welcome back to Bloomberg Surveillance and thank you for sharing your time with us this morning. Let's start there. Let's look at your time at the International Monetary Fund. Just how much has changed over almost a decade?
Hi, and a pleasure to join you. Pretty much, I think everything has changed. I started at the IMF in 2019, and that feels like that was the calm before the storm. And you had the pandemic, you had war in Ukraine, and now geoeconomic fragmentation. I think the global economic order is transforming in ways we haven't seen in decades, and it's still highly unclear where the global economy will settle. I think a second big difference between 2019 and now is on the fiscal front. Debt levels are incredibly high. They are ever increasing. And while in the past you might have said, so what, markets will take it, that's not the case anymore. Even in advanced economies, you see that in France, the UK, and also in terms of long yields in the US. And I say the third big change is on technology. AI over the last few years has certainly caught the imagination of everybody, huge promise, but also huge risks.
How has the IMF's role changed during this period, given that it was set up under a very different infrastructure at a time when a lot of people are saying we're now in the post-Bretton Woods era?
The IMF has great experience dealing with turbulence. You know, there was a period when you had the end of Bretton Woods going off the fixed exchange rate to the dollar and the dollar to gold. That change happened and the IMF adapted. And we are obviously now in a world with big shifts in terms of how countries work with each other. The IMF has always functioned as trying to do the art of the possible, which is do the best you can given the constraints, and done it very successfully. So if ever there was a time for this institution, it's super important now. It has the ability to bring different countries together around the table, good discussions to happen in the economy, on the outlook. Again, a very vital institution for the world.
Do you see a risk that it doesn't survive, though, at a time when funding is really in question with a lot of major economies? We've seen China go it alone. There have been questions about the United States.
Firstly, the IMF's funding structure doesn't rely on any budgetary support from any country. So it's in a very strong place because of that. And everything we've seen so far points to all the members wanting the IMF to continue functioning as it has. We work very closely with the U.S. administration. That engagement is going extremely well, but also the other 190 member countries that we have. So as of now, lots of support. Of course, the environment has changed, and the IMF is going to adapt to it in this new geopolitical environment that we have. But it has a lot of experience dealing with these kinds of events.
One thing that you've done during your tenure at the IMF is really study the change in the geopolitical relationship. You've talked a lot about that, including the reliance on the dollar, and that's been a point of big speculation of late in markets as well. How much are you actually seeing worldwide nations try to shift to alternatives from the greenback, this idea of insulating themselves from some of the policy uncertainty that have made a lot of headlines this year?
So we do see small shifts on the margin, right? We are seeing countries diversifying out of the U.S., but again, on the margin, because they were so exposed to the U.S., several of them are hedging against dollar risk. We're seeing some of that too. But I think the narrative that somehow something has dramatically changed about the behavior of the dollar, it's really too early. People point to the correlation between what's happening with long-term bond yields and the strength of the dollar and saying, well, that's changed, and therefore something has changed dramatically. That's not the case. If you take a long enough enough period, the relationship between the dollar and the borrowing costs is, it can move in different ways. So there's nothing unprecedented. But of course, these are still early days. We shall see where all of the shifts in the global economic order are headed. And I think that's the source of tremendous uncertainty that's still weighing on the world economy.
How much has any perceived loss of Fed independence changed that? And we've been talking about how there's this dissonance between the commentary by a lot of analysts and economists about the fear of some sort of loss of independence and then a lack of market reaction that you would kind of expect on the other side. Are you seeing any shifts that maybe are less visible?
I think everybody agrees, and this would be markets and economic professionals, policymakers, everybody agrees that central bank independence is critical, monetary policy independence is critical. So if we are not seeing much market reaction, it must be that people think that, well, that independence is still intact. That independence has been critical to bring down inflation from the high levels we saw post-pandemic. Inflation expectations were anchored. Because of that, inflation came down. So I don't think there's any ifs and buts about that. It must be that everybody still believes that independence, especially operational independence in terms of setting monetary policy rates, will be maintained.
So you reject the idea that the market's just somehow ignoring a reality or something like that. You think the market's speaking and that we should listen to the market?
No, I just think that everybody at this point is functioning under the fog of uncertainty. I mean, there's really a lot of information thrown out there. Separating the wheat from the chaff, it's not that easy. And so I think everybody is on wait and see mode. And right now, at least, of course, I think that the markets are putting very, very low probability on any big negative event. That may be excessive. I think there is more to worry about than what the markets are showing right now. But again, we should have to wait and see.
And Gita, let's put some of these things together. If you look at developments in the UK, in France, the inability to address fiscal concerns and find that additional fiscal space, the latest developments here in America as well, are you witnessing, do you think we're witnessing a convergence between the kind of dynamics we typically see in EM with DM? And do you think those terms are useful anymore in quite the same way?
I think we have certainly moved away from the case of advanced economies, rich economies can keep increasing their debt, which is what's projected to happen, and there's not much to worry about. I think we're certainly past that. Major economies are beginning to worry about what's happening to their yields. You're seeing that. It's a major concern in France right now as we speak. But even in the U.S., long-term yields are basically back to pre-GFC level. We are away from that world of big global savings glut, away from that world of central banks buying large amounts of government assets. So I think it would be really complacent for any government, rich or poor, to say that, well, no, our debt will always be bought. And I think one point I want to make is that we talk about resilience for the global economy, which has been really the positive of these last many years, despite all these shocks. But we should recognize that the reason we've seen resilience is because we haven't had a financial crisis, despite the pandemic, despite wars, despite geoeconomic fragmentation, despite Fed rates going up very sharply. We've not had a financial crisis. That doesn't mean that that will never happen. We have very high levels of debt around the world. I think bond markets are in a fragile place. You have valuations in equity markets that are sky high. So I would say tread carefully, because if you do have a financial crisis, we know the scarring that comes from that is long lasting.
And when you talk about a financial crisis, some people were wondering what could potentially trigger it. Are you saying that the sovereign debt market of developed markets is of the greatest concern at this point?
I mean, usually when you get a financial crisis, it's a combination of events that can trigger it, right? And so if you have multiple markets that seem to be in a vulnerable position, you could end up with a negative event, right? And so the bond markets, what you're seeing with very high levels of debt, fragility associated with that, equity valuations that are very high. Yes, there's a promise that maybe AI will truly transform the world, but as we know from the dot-com bust, even a technology like the internet that did transform the world went through a boom-bust cycle. So that combination, non-bank financial institutions, we've never had a crisis. Well, they've been as large as they are right now. The amount of corporate borrowing that's happening with NBFIs, much higher than pre-2019. So there's a lot that looks stretched at this moment. And at the same time, I think the world economy is gambling with all kinds of new policies. So I would say tread carefully, make sure that financial supervision and regulation is continued. See what needs to be done with NBFIs, what's the appropriate level of supervision and regulation that's required over there. All of that is going to be very important.
So you're leaving the IMF and you're going back to Harvard, a university that you've known very well. What are you going to be doing there, and how important is it for you to really get the sense back in the economics profession of pure research and true rigor versus some of the politicization that we've seen recently?
So I think the reason that the economics profession has been able to contribute so well over these last few years is because in the face of unprecedented shocks, you really need to go back to some of your training to figure out how you're going to respond to a pandemic that you haven't seen in 100 years or war in Europe, right? So having that base of knowledge is very important. But at the same time, I think the economics profession has to recognize that there is something of a trust deficit, especially with mainstream economists, and how do we get over that? There's broad consensus in the economics profession that open trade, central bank independence, super important. Those are the crown jewels for good economic policy. And yet the policy direction is away from that. So I think there is absolutely some bit of soul searching, some bit of stepping back and asking yourself, how do you solve this trust deficit? How do you make sure in this new world of communication that the good ideas still come true?
Stay with us. More Bloomberg surveillance coming up after this. Dan Ives, the global head of tech research at Wedbush, writing, "We view any decline in Nvidia stock to be a clear buying opportunity as it remains the only game in town fueling this fourth industrial revolution." Dan joins us now for more. Dan, you've seen the headlines. The boom is over. What's the pushback this morning?
I think the boom's just starting. I mean, if you look at these numbers, especially when you factor in what China is going to be, I mean, Jensen talked about 50 billion, 50% type growth number. This just shows the next stage of adoption is actually just starting. I think this stock is green today.
By the end of the day, Dan, that's what you're saying. You think that by the end of the day, people will realize, come around to your point of view, that actually what the disappointment was a non-inclusion of any China sales, but a real robust growth elsewhere. Is that your argument?
You just exactly summarize it, because the reality is that when you look at data center and then you actually factor in what China is going to be, when you look at 2 to 5 billion and you look at the acceleration in the next few quarters, I mean, there's no region that's not accelerating. And now in China, with the pay for play model back in, you're talking about it could be an incremental 20, 25, 30 billion. That's why it comes down to the godfather of AI, Jensen, Nvidia, continue to dominate this. And I think this is just a further validation. Tech stocks go higher.
Dan, I feel like we should do a show Where in the World is Dan Ives of Wedbush, because you're always somewhere different. And this morning, it looks like you're down under in Sydney. And I'm curious about the rest of the world. It's actually really telling that you've been traveling the world, because outside of China, Nvidia's growth has been tremendous. And we've seen a real increase, particularly in other Asian countries. How much does that give you that extra bullish push that even if it's not China, you are seeing the rest of the world rush to adopt as much as they can of Nvidia before maybe some of the policies change?
Yeah, look, and I think you see that when you look at Middle East. I mean, Middle East is a perfect example where they're just continuing to just massively build that out, when it comes to Saudi, UAE. Look, the reality is that they're years ahead of any other chip player. I mean, you look at everything happened from a Huawei perspective. They've narrowed the gap, but the reality is that every Chinese big tech player wants NVIDIA chips. And I think what you start to now realize is that you talk about a third of that overall revenue going to NVIDIA. This is trillions that's going to be playing out. That's why I believe there's a $5 trillion market cap, either by year end or early 26.
But Dan, the China policy is subject to change on the U.S. side, and also we have seen in the past Beijing telling firms not to buy NVIDIA chips. Can this company continue to grow the way you envision if, say, China was taken out of the play?
Yeah, look, there's no doubt. China continues to be, that's the golden goose for Jensen and Nvidia. But that's also why, look, Jensen, 10% politician, 90% CEO. And when you think about the China market, but also Beijing telling Chinese companies, big tech, not to buy Nvidia chips, that's like telling a kid, oh, don't eat the candy. The reality is they want Nvidia chips. They don't want to have a third, fourth rate chip. And that's why Jensen knows it. And they're going to continue to kind of play this policy. And I think we sit here 6, 9, 12 months from now. China's a $50 billion annual market for them.
Jensen Huang last night said they keep advocating on the sensibility of and importance of American tech companies to lead and win the AI race. Basically, we keep lobbying the American government when it comes to Blackwell. Do you think at some point they'll be able to sell those chips into China?
Pay for play model, right? I mean, maybe that 15% goes to 25%. Look, because Jensen understands that what they can sell, that gives Huawei and China that much more power. And I think in this AI arms race between the U.S. and China, biggest poker chip on the table continues to be Nvidia. And I think that's the reality. There's no one that has more influence when it comes to AI, relative to Trump than Jensen. I mean, he's become really, I think, a big strategic advisor for Trump administration when it comes to AI.
Dan, nobody's saying the growth story is going away. We don't think this is going ex-growth. No one's suggesting that. We're going to see healthy double-digit growth figures based on what we heard from the company overnight. What they are suggesting is that the level of growth is going to change. And perhaps we need to reassess our view of this company with that in mind. Dan, how have you changed your view as growth decelerates, just by definition?
Yeah. I mean, look, my view is that as you start to actually go into physical AI world and you go into autonomous, you go into robotics, you look at the next few years, I could argue Street's underestimating numbers 25, 30% next few years. So I think as this actually plays out, my view is like, Nvidia is undervalued relative to where this is all going. And we're only in, like I've talked about, the AI party was 9 p.m. It's now 10:15 p.m. That party goes to 4 a.m. And Jensen's going to be out there on the dance floor because he and Nvidia are leading the AI revolution along with the hyperscalers and Palantir.
What's become clear, though, from the earnings of the likes of Microsoft and Google or Alphabet is that there is some pushback when it comes to the investor and community about how much some of these companies are spending. And it needs to broaden out in a significant way. And if it does, that raises questions about how much Nvidia has to steal market share from other players. Who's going to be the biggest loser as Nvidia continues and charts its path over complete dominance of this industry?
Yeah, look, losers are clearly Intel, right? I mean, despite obviously what we see with U.S. government and, and obviously SoftBank, I mean, I just think there's a better chance of me playing Ryder Cup Bethpage than Intel gaining share. And I think that's part of the issue is that AMD is going to gain share. Nvidia is going to gain share. You're clearly, Broadcom and others, but I think it's a have and a have-nots that's going to continue to play out. But you look at last night's quarter, along with what we've seen from earnings, as a bull, you feel really good in terms of the validation story for AI.
Dan, before you go, should Keegan Bradley have chosen himself?
Look, I think he could have chosen himself. It was obviously maybe a good decision for him, but I think ultimately U.S. wins that Ryder Cup Bethpage.
Stay with us. More Bloomberg surveillance coming up after this. Stuart Kaiser, the head of equity trading strategy at Citi, writing the following. Nvidia's earnings is the largest event for the S&P 500 over the next month. For equity investors, the AI theme and the impact of that on returns is on par with the Fed. Stu joins us now for more. Stu, good morning.
Good morning.
Things are pretty calm, aren't they? What do you make of that?
I think the Nvidia numbers were just about good enough, effectively, probably right at the low end of where the whisper number was. The China stuff obviously adds a little bit of noise to it, but I mean, margin 70, 73.5% exactly where they wanted to be, $54 billion in revenues. I think that the test here was if Nvidia was really strong, what would it have done to the Russell trade? And I think that's what a lot of people were sort of debating was if we get because Snowflake and MongoDB, both very strong results on the software AI side. If you had gotten that from Nvidia, would that have made people U-turn out of the Russell and value trade back into growth? It doesn't seem like the numbers were strong enough to do that, but they were strong enough to keep the S&P from selling off.
So a milquetoast Nvidia report is good for small caps?
At least tactically. As Lisa highlighted with the mix of policy versus data, I think that small cap trade has really poor risk reward as we go into September because it's a careful what you wish for. Good news, bad news type situation.
You love
exactly. But yeah, I think the Nvidia report kind of like threaded the needle, right? It was strong enough that you didn't get kind of a liquidation in those long positions, but it wasn't so strong that it disrupted the rotation that's been going on for the last couple of weeks.
Is this actually a connected idea that somehow big tech winning is small companies losing? Or is this just simply that markets can only focus on one idea at a time? And if they're not focused on AI, they're focused on the Fed?
Yeah, it's probably a little bit of both. But yeah, I would agree with that. I think there is some view that how do you keep up with the spending that these hyperscalers are doing, or if you're a smaller company? The market right now is to some degree in one big trade, right? And that trade is long growth, long large cap, long the AI thematic, right? And everything else has sort of been ignored to some degree. What we saw in August is people trying to re-engage with those smaller cap, lower quality laggards to some extent. And to your point, I mean, there's a limited amount of money, right? And money's got to be in one place. And right now it's getting kind of rotated a little bit into that value trade.
Is any money coming out of bonds and going into stocks? And this is something that a number of people had been flirting with earlier in the year, the idea that they could get better yield on stocks at a time when inflation was going to be a little bit more elevated than, say, bonds, especially with uncertain policy.
Yeah, it'll be interesting to see if the Fed actually does start cutting and those money market yields actually get down to a level where it's a little bit attractive. If we see a re-engagement, if you look at the balances in retail money market funds, I mean, you're at like $3 trillion. It's a lot of money. Not all of that is coming into stocks, right? I think some of that was basically bank account money that got put into money markets for yield. I don't necessarily know that would go directly into equities, but there's a potential you get a little bit of a tailwind there. The question there, though, is if there is why are they cutting is ultimately what this gets into. If they're cutting because the labor market is falling apart, money is not going to be rushing into equities, and that's going to be net negative for Russell, et cetera. If they're cutting because that sort of base case is in play where they're just gradually going back to neutral and an otherwise solid economy, then yeah, you might get money out of bonds into equities.
Well, with the event of Nvidia behind us, what's the market going to be focused on now? Is it squarely on the labor market report ahead of the Fed meeting?
Yeah, I think it's payrolls, and then September 9th, you get the BLS revision to payrolls, which, as you cover Trump, I'm sure that'll be very sort of toxic event.
Trump said this week in the cabinet meeting that he expects a very strong labor market report.
He might get a decent labor market report, but look, I mean, consensus is sub 100K. Chair Powell last week said break even on jobs right now is 50 to 75K. So look, I mean, a strong report right now will probably be 125. But our economists think you might get 400,000 negative revisions from the BLS benchmark. That is not going to go over well politically. And honestly, from a market's perspective, that's a sneaky event on September 9th. How many jobs get kind of revised out of the BLS?
It's a really odd setup, isn't it? This market's pricing in a cyclical upturn. Federal Reserve's really increasingly concerned about a cyclical downturn. What gives?
I agree with you 100%. I actually thought the response to the Fed was much more positive than I would have guessed. I think what happened was the initial headline was, about they're getting ready to cut. But if you read his speech, it was because they are seeing some, weakness in the labor market. Not only are they seeing weakness, they think the risk reward is really poor. And then a lot of folks, I think, believe that they're prioritizing growth, but he also specifically said we're not going to allow tariff-driven inflation to become a bigger problem. So I was surprised, honestly, at how positively the market reacted to the Fed. But yeah, I'm with you. I think you have a little bit of, I don't want to say a disagreement, but you have a situation where the Fed is clearly worried about the growth side of their mandate. The market has been willing to ignore that to some degree. And as I said, I think that gives you really poor risk reward in some of these smaller cap trades.
There's a phrase I really don't like, but I'm going to use it, hawkish cap. Is that kind of what you're thinking about going into September 17th? Of course, all relative to what's expected at the time and what comes in on the data front over the next few weeks. But is that where you're at now?
I guess, in the sense that, they are probably going to cut. And yes, I think they're going to be very cautious in how they message that, in the sense that this is not an aggressive kind of cutting regime. Now, look, if you get a very weak labor market report, that cut may not come across as hawkish. So, they are very, very data dependent. But all else equal, let's say we print a consensus job number of, call it 75K, and you get an okay inflation print, then yes, they'll cut. But to your point, they're not going to message this as an aggressive cutting cycle. They're probably going to message this as a meeting by meeting process that is data dependent.
So if you just turn this on its head and take it a step further, is this essentially a market that's hoping this is a politicized rate cut, and that it's going to be a politicized rate cutting cycle that doesn't necessarily warrant it based on where the economy is, which will give fuel to equities but won't actually be as a result of economic weakness?
Well, to keep myself out of trouble, I'm going to call those insurance cuts. Yes, and I think the market would probably, enjoy some insurance cuts. Look, there is a sneaky Uber bull case out there lurking, right? Okay. Which is that for 3 months, corporate America sat on their hands, did less hiring, did less capital investment because of the uncertainty around tariffs and taxes and immigration. And we get into September, things have calmed down, and you have budgets that need to be spent into year end, and you get some hiring. That is a low probability, but very kind of, bullish outcome.
You say that it's low probability, but I was looking at your very own economic surprise index, and it actually is at the highest, the most positive going back to the end of last year. So if you see, yes, the economic data hasn't been great, but it's been trending in the right direction. It's actually going the opposite direction of some sort of doom and gloom in the economy. So how do you square that with the idea that there really is weakness under the hood that the Fed is responding to?
Well, what's interesting about that, too, is a lot of it's coming from the soft data, which is survey data. UMich was actually quite weak. So it's the survey data that's improved.
You're triggering.
No, but the survey data that's improved has been corporate survey data. It's been the PMIs. So in the sense, if you believe that corporates are going to re-engage, that's very positive news. If you're worried about the labor market, you're kind of a little more circumspect about it. So agree that the data looks pretty good. Look, economic surprise can be positive for two reasons. It can be really strong data or really low expectations. In this case, it might be that the expectations were kind of low and we're clearing a relatively low bar.
That kind of set up with corporate America having the one big beautiful bill, deregulation, and some clarity on tariffs. What does that mean for the Fed in 2026?
I mean, it probably means the Fed will be really, if they're in a cutting cycle, doing it very, very methodically and maybe like a quarter-to-quarter basis instead of a meeting-to-meeting basis. Look, if you were to have all of that stuff kind of coalesce into a little bit of an upturn in the U.S. economic data, then, the Fed is going to be much more focused on ensuring that the inflation risk is out of there. I mean, you have a Fed chair who was there during an inflation surge, is getting ready to leave that seat. I can't imagine he wants to leave that seat with inflation pressure again kind of being an issue. So it would actually be a blessing for the Fed, I think, if you got an upturn in corporate economic activity that allowed the Fed then to kind of take their time.
I didn't take you as a UMich kind of guy. I used to be a UMich kind of guy, and then I realized the respondent rate, the response rate is just ridiculous.
Yeah, you need to defend yourself here because, a UMich kind of guy evidently is sort of your new kind of...
it's like conspiracy theorist, UMich kind of guy,
This is what happens when the British come. They don't like the Dow. They don't like...
I don't think Governor Waller likes the UMich.
They're anti-America.
Well, please.
Oh,
is UMich anti-American? Oh, boy.
Stay with us. More Bloomberg surveillance coming up after this. We'd like to bring in Nela Richardson, the chief economist over at ADP. Nela, good morning.
Good morning.
If you took some time off, not that you ever do, but if you did, and you didn't know any of the economic data, and I just showed you jobless claims, would you have a decent read on the labour market right now?
Yes, I would think it was pretty strong. But if I unpacked it a little bit, and I haven't taken a lot of time off, actually, so I've been unpacking quite a bit. I actually identify 4 crosswalks between macro trends that are big in the making and also the very granular real-time data that we're seeing. And the first one is the consumer. That consumer spending, which you're seeing picked up in the GDP numbers, has been a resilient driver of the labor market as well. So where you see strength in in the consumer, you're seeing strength in the jobs market, namely leisure and hospitality, and there's some trade and transportation that has been strong. But then you see this other macro theme of uncertainty, and I think that's depressing some job gains in professional services. So there's a lot going on between the big picture macro trends and the smaller, granular, real-time hiring that businesses are doing right now.
How much is there stealth firing or sort of attrition plans that are in place that don't make it some of the overall numbers as necessarily job losses in the traditional way?
You know, this is a super, and I'm glad you asked me this question because it's a super complex question. Because what we're seeing on the part of the employer may not be demand driven. First of all, we had this great big resignation in 2022, and young people are supposed to turn over. They're supposed to leave these jobs, they're staying put. And so there's a little bit less hiring because people are staying put. And then you have the effect of AI. There's been new research from Stanford that was out using ADP data. A paper was released yesterday saying that in AI-exposed fields like software developers or customer service reps, you are seeing an impact in early career. So you can't look at the macro. You have to dig beneath the surface to see all the things that are different about this labor market, making it very challenging to predict its next moves.
But do you get a sense of whether it is weakening in a way that would justify some sort of Fed move or that would require some sort of policy adjustment? Or is it just transforming? Is it just a structural shift that has nothing to do with policy, frankly? It has to do everything with technology.
Yes and yes. And that's what makes it so hard. Yes, it is weakening. We are seeing a slowdown in hiring momentum. It's a slowdown from the beginning of the year. It's a slowdown from last year. Some of that is what Chair Powell said in his speech, that we're seeing lower supply, lower demand, but still some equilibrium that gives us a pretty good unemployment rate. But yes, it is structural. We're seeing aging demographics really cut into labor and these nascent technologies affecting early career in real time. So yes and yes, it's both, and that's why you can't predict it. You're going to see companies be hesitant and slow down their hiring because of macro trends that have nothing to do with their customer base. And then they're going to come back in the market and hire when they need to. And so we won't know if a 1 month slowdown is indicative of a really weakening labor market or just some hesitancy. So we have to look at a couple more months to get that trend right.
The Ocean First Financial CEO was just on. He was saying with his commercial clients, they're not hiring as much because of AI. You were at Jackson Hole. The theme was labor and transition, yet you said no one presented a paper on artificial intelligence. Is the Fed too late to really understanding what's going on?
You know, it's so new, and it's a great question. These themes, these papers in general, I mean, economists have a lot of good attributes. Being on track all the time in the micro data is not always one of them. So some of them, I know, it's a big reveal. So these papers are really important. They had big themes like fertility and population growth and mobility.
But what's happening right in front of them right now?
But AI is harder because you have to have granular data. And that's why this paper that I mentioned from Stanford, looking at ADP's millions of job titles, you actually see the effect AI is happening. So for employers, there are some big investments in AI. Some of that investment will augment career. So for later career, more tenured workers, AI is seen to boost productivity, and those investments are being made by companies. But for jobs that are easily automated, you might see a transition of those workers, and you're already seeing that transition happening. I think it's going to be short term. I think labor shifts to where the puck is heading when it comes to productivity, but we're in the midst of that transformation right now. And yes, it's not really being picked up in economic models.
If your eyes are just tuning in, welcome to the program. Just moments ago, some economic data on GDP and on jobless claims. Mike McKee standing by, who has a little bit more. Mike, you've had a second look. What do you see?
Well, we can see what's under the hood here, and the basic reason we saw a rise in GDP in the first revision for the second quarter is personal consumption rose to 1.6% from 1.4%, and business investment significantly increased. Non-residential fixed investment up 5.7%. It was 1.9% in the original print. Exports were down 1.3%, a little bit less than they were in the initial print, and imports were down 29.8%, basically unchanged changed in terms of overall trade numbers, but we did see that shift from the first quarter to second quarter, where imports were huge in the first quarter and dropped off negative, actually, in the second quarter. And then finally, we had the federal government spending down 4.7% and non-defense spending down 12.5%. So a big drop there in what the government was spending. And the bottom line, and Nela will appreciate this, I guess, as one of those economists who looks at the micro and macro numbers, is that real final sales to domestic purchasers were up 1.6% over 1.1% in the first initial print. Overall, real final sales 6.8% from 6.3%. So we have a little bit stronger GDP than we thought we had in the second quarter. Of course, now it's all about quarter three.
Mike McKee, just before you go, it feels like in April there was some paralysis in the economy. A lot of people held back trying to work out what was happening with policy. Are you getting a clean read on anything to do with just things bouncing back, that maybe we will see that reacceleration as the year progresses and people re-engage with the economy?
I think we're too far away from the second quarter numbers to say that this revision has much bearing on what's going to happen. The good news was that businesses were spending in the second quarter, and that's been what everybody's watching. Were they going to hold off or not? Consumer spending continues at a slower pace than it had, but they're still hanging in there. So where do we go from here? Everybody's been waiting to see what effect the tariffs would have, and this is about the time when we're going to start seeing that.
Mike McKee, appreciate it. Mike, thank you, sir. As always, Mike on the data there. Nela's still with us. Nela, we wanted a word from you on the Federal Reserve. September in some ways feels like an easy call now. They're going to cut rates. How would you set things up for people for September and beyond into 26 of the Federal Reserve?
I think it's really helpful to look at how the Fed has moved historically, which is in small bites, moderated over a long time frame. That may not be the way that they can act now because there's so many moving parts of this economy. Whether you think that tariffs are a one-time price increase or have ripple effects, the fact is the lags between monetary policy and the lags between what's going on in the economy, they might miss each other. And so I expect a Fed that will be constantly data-driven and may have to pause to recalibrate where the economy is moving. I don't think it's going to be clear to them even when they start acting.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.